Hi, it's Paddy Hirsch at Marketplace, and today I want to talk about the difference between fiscal policy and monetary policy. Seems to be a bit of confusion here. People conflate the two. People also conflate the roles of the Treasury and the Fed and Congress. So let's see if we can sort this out. Straight explainer, no analogies, just the facts, ma'am. Okay, so first we have fiscal policy. Okay, and fiscal policy is what the government does, okay, to work on the economy. And essentially it's got three main tools that it can use: taxes, spending, and then if it has any shortfall there, debt, which is of course the issue of government debt. And the agent of the government's fiscal policy is of course our good friend Tim Geithner. There he is, Mr. G. Okay, he is of course the Secretary of the Treasury. All right, so that's fiscal policy. All right, that is the use of taxes, spending, and debt to control or influence the state of the economy. So what's monetary policy? Okay, monetary policy is also used by the government, but it is used by a certain branch of the government, which isn't really a branch of the government. A little bit confusing. What I'm talking about is, of course, the Federal Reserve, otherwise known as the Fed, headed by our big man, of course, our good friend, Uncle Ben Bernanke. He is with his beard. Okay, Mr. B, the chairman of the Fed. All right. So here's the thing about the Fed, all right? The chairman and the 12 governors of the Federal Reserve are appointed by Congress. And the Federal Reserve itself, okay, is overseen by Congress. But the Federal Reserve is much more independent. It's not a branch of government like the Treasury is. It's very independent. It could use all of the tools that it has as it likes. And all it has to do is just check in with Congress every now and again. And you've seen Ben Bernanke sitting on the Hill talking to them. So what has the Fed got in its toolbox to influence the economy in so-called monetary policy? It's got a number of things. I'm just going to run through them. The first thing is interest rates. Okay, we have all heard about those things. You know, if they have a target rate, they want banks to lend at a certain rate. That can influence how much money goes in and out of the banks. The next thing is the money supply, also called which is influenced by what's called open market operations. Okay, so open market operations. And what that is, that's when the Fed goes out and it buys debt, buys treasuries from the banks. The more treasuries that it buys, the more money that goes into the banks, and then the banks will presumably lend. The next thing is the use of the discount window. Okay, the discount window is where the banks go to borrow from the Federal Reserve. And depending on what the rate is at the discount window, the banks will be able to borrow more or less, you know, and again, hopefully be able to lend out more or lend out less, depending on where the rate is. The next thing is the currency peg, which they could use, which doesn't happen often. That's when the Fed might just say, oh, we're going to peg our currency to another currency. I mean, that's kind of like way out there. But it is true that other countries do occasionally use currency pegs. And in fact, Switzerland was considering doing it. It was like on the agenda of consideration whenever they were worried about protecting the Swiss franc. Although, you know, that obviously didn't happen. The next thing is reserve requirements. Okay. So reserve requirements, that's when the Fed requires the banks to park a certain amount of money at the Fed. So it gets a bunch of their assets, a bunch of their cash, their treasury bonds, and they park them at the Fed. And what that does is it forces them, you know, to put a certain extra amount of money aside, and then it means they can't lend that money out. So that's another way of slowing down the economy. Or if they cut the reserve requirement, it would mean more money going in. The banks had more money to lend, so more money going out into the economy. So that's another way that the Fed can influence the banks to get money into the system. So those are the usual ways that the Fed would use monetary policy. And then there are the unusual ways. The first unusual way is quantitative easing, so-called QE. We've done a whiteboard on this before. This is whenever interest rates are at zero, which they are now. And that's when the Fed will buy pretty much anything, vast amounts of treasury bonds in order to get money into the system in an emergency situation, which is, of course, where we are right now. And that's, a lot of people call this printing money, because essentially all the Fed has to do is buy treasury bonds and then just credit the account of the banks. So it's essentially making money out of thin air. Just one thing about printing money, by the way. The Fed prints money actually through monetary policy, but the actual people who print money, the mint, is actually controlled by the Treasury. So that's a kind of a weird thing that people get mixed up. Anyway, the final unconventional method of monetary policy is called signaling. Okay, and that is when the Federal Reserve signals that rates are going to be a certain level for a certain period of time. And we've heard that this has happened recently when the Fed said it's going to remain, or it's going to keep interest rates at zero for the next couple of years. And that signaling allows banks then to say, okay, we're going to be safe for now, we can lend money into the system. So of course what we have now is the Fed has exhausted all of the options that it has pretty much in monetary policy. Okay, so much so that it's into these unconventional methods, which means it's now passed the buck right back to the government again, and we're into the realm of fiscal policy in order to influence the economy. Of course, this is a big problem because that means that politicians have to get together, whereas the Fed can pretty much do what it wants anytime it wants. Whenever we have fiscal policy, it's politicians have to decide what to do in order to give Mr. Geithner, the Treasury Secretary, the power to act, which means they have to agree on how much to tax, how much to spend, and how much to borrow. And they can't, which is what's leaving all of us at the end of pretty much every day very badly needing a drink.